Unique opportunity in oil and gas stocks. Why silver could be next. Wall Street's consensus has declared energy dead capital. Institutional money has abandoned the sector entirely. Yet beneath this surface dismissal, something is shifting. The same structural forces that precede major market dislocations are assembling quietly, the kind of setup where prices don't drift higher. They gap. History shows these moments don't announce themselves. They reveal themselves, only to those paying attention. And right now, there's a parallel pattern forming in silver, one that few are connecting to the energy equation. What the market is missing could define the next 18 months. Welcome, I'm John A.G. Now, before we go further into what the institutions are overlooking, let me ask you something the way I'd ask a wise friend who's seen a few market cycles. If you found value in this analysis, would you consider subscribing? It's just one click, but it tells me you're serious about understanding these markets beyond the headlines. And while you're here, drop a comment. Tell me where you're watching this from. New York, London, Mumbai, Singapore. I read every single one. Let's begin. The global energy market is experiencing something unusual. On the surface, everything appears stable. Oil prices hover in a range that neither excites nor alarms. Production numbers remain steady, and the daily news cycle has moved on to other sectors. But beneath this calm exterior, a structural transformation is unfolding, one that most investors are completely missing. The analyst sits at his desk, reviewing data that tells a story Wall Street refuses to hear. Energy stocks are trading at valuations that seem almost absurd when measured against their earnings power, their cash flow generation, and their balance sheet strength. Major oil and gas companies are generating record free cash flow, yet their stock prices remain suppressed. The price-to-earnings ratios across the sector are sitting near historic lows. Some companies trade at multiples that suggest they'll be out of business within 5 years, yet these same companies are buying back shares, paying dividends, and reducing debt at unprecedented rates. Something doesn't add up. The strategist pulls up a longer timeline. Going back to 2020, that year marked a turning point that few people fully understood. When oil prices briefly went negative, when pandemic lockdowns crushed demand, the entire energy sector faced an existential crisis. Investors fled, capital dried up, and a message was sent throughout the industry. Invest in production at your own risk. What followed was predictable to anyone who understands commodity cycles. Companies stopped exploring for new reserves. Upstream capital expenditure budgets were slashed. Major projects were canceled or delayed indefinitely. The focus shifted entirely to capital discipline, returning money to shareholders rather than drilling new wells. Now, 4 years later, the consequences of that shift are becoming visible. The portfolio manager examines the reserve replacement data. For decades, oil companies followed a simple rule. Replace the barrels you produce with new discoveries. Maintain your inventory. Ensure future supply. But that's no longer happening. Across the industry, reserve replacement ratios have fallen below 100%. Companies are producing more oil than they're finding. The inventory is being drawn down, slowly but steadily. At the same time, global oil demand hasn't collapsed the way many predicted. Yes, electric vehicles are growing. Yes, renewable energy is expanding. But the world still consumes roughly 100 million barrels of oil per day. And that number, despite all the talk of energy transition, has remained remarkably stable. The geopolitical analyst adds another layer to this picture. Oil production is becoming increasingly concentrated in a handful of regions. OPEC Plus controls a larger share of global supply than it has in years. U.S. shale production, once the great disruptor, has plateaued. The days of explosive growth from the Permian Basin are over, not because the resource is depleted, but because the capital to develop it aggressively simply isn't there anymore. Meanwhile, geopolitical tensions continue to simmer. Middle East instability, Russia's strategic positioning, China's energy security concerns. Any one of these factors could remove millions of barrels from the market overnight. Yet the market price is in none of this risk. The commodities trader looks at the futures curve, the structure that reveals what the market truly believes about supply and demand. In recent months, despite surface-level calm, the curve has shown moments of backwardation. That means near-term contracts are trading higher than future contracts. It's a signal that physical oil, actual barrels, are tight right now. Buyers need supply today, and they're willing to pay a premium for it. This isn't the structure of an oversupplied market. This is the structure of a market where physical reality is starting to diverge from paper expectations. And then there's the weather factor. Recent cold snaps across major production regions knocked out nearly 2 million barrels per day of U.S. production. Refineries went offline. Infrastructure froze. Supply chains were disrupted, yet prices barely moved. Why? It's because the market is looking at spreadsheets that show theoretical surplus, while ignoring the physical fragility of the system. The institutional investor reviews the capital flows. ESG mandates, environmental, social, and governance criteria, have systematically starved the energy sector of investment capital. Major pension funds, university endowments, sovereign wealth funds, all reducing or eliminating fossil fuel exposure. This isn't a temporary trend. It's a structural shift in how capital is allocated, and it has consequences. Less capital means less supply growth. Less supply growth means tighter markets. Tighter markets mean higher prices. Eventually. The question isn't if, it's when. And alongside this energy setup, another opportunity is forming, one that few are connecting to the energy story. Silver, a metal that exists in a unique space, part monetary asset, part industrial commodity. And right now, it's setting up in a pattern that mirrors what's happening in energy. Underinvestment, supply constraints, growing demand from unexpected sources. The parallels are striking. But to understand why silver could be next, one must first understand the mechanics of what's unfolding in oil and gas. Because these markets don't move in isolation. They move when the underlying fundamentals reach a breaking point. And that point is closer than most realize. Markets don't break loudly. They fracture quietly in places nobody is watching. The energy trader arrives at his terminal at 4:30 a.m., the same time he's arrived for 17 years. But this morning, something in the data catches his attention. The spread between different crude oil contracts has widened in a way that shouldn't happen in a balanced market. He leans closer to the screen. Front-month Brent crude is trading at a premium to contracts 3 months out, a structure called backwardation. Normally, this might last a few days during temporary disruptions, but this has been persistent, stubbornly refusing to normalize. It's the market's way of screaming, "We need oil now." Yet the financial media continues to discuss surplus scenarios and demand destruction. The disconnect is profound. Across town, a refinery operations manager is dealing with a different kind of problem. Margins have compressed to levels that make processing crude oil barely profitable. The spread between what he pays for crude and what he can sell gasoline and diesel for. The crack spread has narrowed dangerously. This should signal oversupply, too much refining capacity chasing too little demand. But he knows the real story. Refineries across the country have been running at reduced capacity, not by choice, but by necessity. Maintenance that was deferred during the pandemic, aging equipment that breaks down more frequently, regulatory pressures that make upgrades expensive. The infrastructure is deteriorating, slowly but measurably. And when winter storms hit last month, the system showed just how fragile it had become. Natural gas processing plants in Texas froze. Pipelines couldn't maintain pressure. Compressor stations went offline. Within 72 hours, nearly 2 million barrels per day of production simply vanished. The grid operator in the region faced a simultaneous crisis. Electricity demand spiked as temperatures plummeted, but the fuel needed to generate that power was stuck. Trucks couldn't deliver it, pipelines couldn't flow it, storage facilities couldn't release it fast enough. It was a cascade failure, averted only because temperatures moderated just in time. But the close call revealed something important. The system has no redundancy left. Every efficiency gain of the past decade, every cost reduction, every optimization has removed buffer capacity. And markets without buffers don't adjust gradually, they dislocate violently. Meanwhile, in Vienna, OPEC Plus representatives gather for another production meeting. The official statements speak of market stability and gradual adjustments, but the strategic analyst reading between the lines sees a different dynamic. Saudi Arabia and Russia, the two dominant players, have spent 3 years managing supply with surgical precision. They've kept just enough oil off the market to prevent prices from collapsing, but not so much that prices spike and destroy demand. It's a delicate balance, and it works, until it doesn't. The upcoming March meeting carries unusual significance. Producers are expected to maintain the current production freeze, not because they want to, but because they have to. Several member countries are producing at or near maximum sustainable capacity. There's no spare cushion to flood the market, even if they wanted to. This is the part that escapes most analysis. OPEC Plus isn't holding back supply as a strategic choice. They're holding back supply because that's all they can do. The excess capacity that once existed, the ability to add millions of barrels within weeks, has eroded. Investment has been deferred. Fields have matured. New projects take years to develop. The market has priced in a world where supply can always respond to demand, but that world no longer exists. Now, shift focus to silver. On the surface, silver seems unrelated to oil and gas dynamics. But the institutional portfolio manager sees the connection clearly. Silver sits at the intersection of two powerful forces, monetary uncertainty and industrial transformation. As a monetary metal, silver has a 5,000-year history as a store of value. When currencies weaken, when inflation accelerates, when confidence in financial systems wavers, investors move toward tangible assets, Gold gets most of the attention, but silver often moves faster and further. The gold to silver ratio, currently hovering near 85, suggests silver remains historically undervalued relative to gold. In previous commodity cycles, that ratio compressed dramatically, sometimes falling below 50. That's a potential 70% outperformance just to reach historical norms. But silver's industrial demand profile makes it even more compelling. The renewable energy analyst pulls up consumption data. Every solar panel requires silver paste for electrical conductivity. Every electric vehicle uses significantly more silver than a traditional car. 5G infrastructure, medical devices, water purification systems, all require silver in quantities that can't easily be substituted. Global industrial demand for silver has been rising steadily, even as mine supply has stagnated. The Mining Executive Reviewing Project Economics understands why. Silver is rarely mined as a primary product. Roughly 70% of silver comes as a byproduct of mining other metals: copper, zinc, lead, gold. When those base metal prices are weak, silver production suffers. When those mines cut back, silver supply tightens. And right now, underinvestment in mining is as severe as underinvestment in oil and gas. Major silver mining companies haven't developed significant new projects in years. Exploration budgets have been slashed. Permitting timelines have stretched. Environmental opposition has intensified. The easy silver has been mined. What remains requires higher prices to justify extraction. But here's where it connects back to energy. The coming energy transition, the shift toward electrification and renewables, requires massive amounts of both silver and copper. Yet the mining industry, like the oil industry, has been starved of capital for years. The commodities strategist sees the setup clearly. Policymakers want energy transition, but they've systematically defunded the resource extraction needed to make it happen. They want electric vehicles, but haven't secured the metal supply chains. They want solar panels, but haven't ensured adequate silver production. It's a fundamental mismatch between political aspiration and physical reality. And when physical reality asserts itself, prices adjust violently. The hedge fund manager allocating capital across commodity markets recognizes the pattern. Both energy and silver are exhibiting the same characteristics: underinvestment, supply constraints, growing demand, and institutional neglect. These are the ingredients that precede major price dislocations. Not the kind where prices drift higher over years. The kind where prices gap higher over months, catching the majority completely unprepared. The mechanism is always the same. Markets price in what seems obvious until the obvious turns out to be wrong. And by the time the correction begins, it's too late to position defensively. The only defense is to position early, before consensus shifts, before narratives change, before prices reflect reality. That moment is now. The institutional investor opens a file he hasn't looked at in years. Inside, charts from 1999 through 2008, a decade that transformed commodity markets, and the portfolios of those who understood what was coming. He remembers it clearly. In 1999, oil traded below $12 per barrel. Energy stocks were considered value traps, unloved, ignored, left for dead by a market obsessed with technology and the internet boom. Fund managers who held energy positions were questioned by their clients. Why are you wasting capital on oil companies when the future is digital? The narrative was so powerful, so universally accepted, that it became dangerous to bet against it. But some did. They looked past the narrative and focused on the fundamentals. Global oil inventories were declining. Capital expenditure and exploration had collapsed. Emerging markets, particularly China, were beginning to industrialize at unprecedented scale. The setup was perfect. When the move came, it wasn't gradual. Oil went from $12 to $140 per barrel in less than a decade. Energy stocks didn't just outperform, they obliterated every other sector. Companies that were trading at 4 times earnings went to 12 times earnings, while earnings themselves quadrupled. $100,000 invested in the right energy companies in 1999 became $1 million by 2008. But here's what most people forget. The biggest gains didn't come in the final rally when everyone saw it coming. They came in the early years, 2001 to 2004, when the setup was clear but nobody believed it, when positioning was still cheap, when conviction was rare, when being right felt lonely. The analyst closes the file and opens another. This one shows the period from 2020 to 2022. A different kind of commodity surge, but with familiar characteristics. Pandemic lockdowns crushed demand, prices collapsed, producers cut back aggressively. Then, as the world reopened, demand returned faster than supply could respond. Oil spiked from $20 to $130 within 2 years. Natural gas in Europe went from $2 per MMBtu to nearly $70. Companies that survived the downturn generated cash flow they'd never imagined possible. But this time, They didn't reinvest it aggressively. They learned from past cycles. Instead of drilling, they returned cash to shareholders. Dividends increased, buybacks accelerated, debt disappeared, balance sheets became fortresses. And now, in 2025, those same companies are trading as if they're in terminal decline. The market has decided that energy is a melting ice cube, shrinking inevitably towards zero. But the data tells a different story. The energy equity analyst pulls up current valuation metrics. ExxonMobil, one of the largest integrated energy companies in the world, trades at a price-to-earnings ratio of 11. Chevron sits at 10, ConocoPhillips at 9. Compare that to the S&P 500 average of 24. These companies are generating free cash flow yields of 8% to 12%. Meanwhile, technology companies with no earnings trade at valuations that assume perpetual exponential growth. The disconnect is staggering, but it's not irrational, it's structural. Capital allocators have been told, explicitly, that fossil fuels have no future. ESG mandates require divestment. University endowments face pressure from activists. Pension funds adopt net zero commitments. The result? Forced selling regardless of valuation. But forced selling creates opportunity for those not bound by the same constraints. The value investor reviewing sector positioning sees something else. Energy stocks now represent less than 4% of the S&P 500. 20 years ago, they were 13%. This isn't because energy companies got smaller. It's because other sectors inflated, while energy was systematically underweighted. When a sector drops to 4% of index weight, it means two things. First, very few people own it. Second, very few people are watching it. And that's when mispricings become extreme. Now, the silver mining executive opens a different presentation. This one shows the operational realities of silver production. In 2024, global silver mine supply was roughly 830 million ounces. Industrial demand alone consumed nearly 600 million ounces. Investment demand, jewelry, silverware, and other uses consumed the rest. The market was roughly balanced, but only just. Now look forward. Solar panel manufacturing is projected to require an additional 200 million ounces annually by 2030. Electric vehicle production will add tens of millions more. 5G infrastructure, industrial applications, medical technology, all growing. Where will that silver come from? New mines? There are almost none in development. Existing mines increasing output. Most are mature and declining. Recycling? It helps, but can't close the gap. The only variable that can balance this equation is price. Silver needs to rise enough to incentivize new production and simultaneously destroy marginal demand. But here's the challenge. Many industrial uses of silver are non-negotiable. You can't build a solar panel without silver. You can't substitute it easily in most applications, which means price elasticity of demand is low. The metal has to come from somewhere, and if primary supply can't deliver it, prices must rise until they do. The precious metals strategist examines the gold to silver ratio with particular interest. Currently at 85 to 1, meaning it takes 85 ounces of silver to buy 1 ounce of gold. Historically, that ratio has averaged closer to 60. During commodity bull markets, it's compressed to 30 or even lower. If silver simply reverted to a 60 ratio with gold at current prices, silver would need to rise 40%. If it compressed to historical bull market levels, the upside exceeds 180%. But this analysis assumes gold stays flat. What if gold itself is in the early stages of a bull market driven by currency debasement and geopolitical instability? Then silver's move becomes multiplicative, not additive. The hedge fund manager constructing the trade sees the asymmetry clearly. Energy and silver share a common characteristic. Both are essential to the economy, yet both have been systematically neglected by capital markets. Energy because of ESG divestment and transition narratives. Silver because it's too small for large institutions to trade efficiently and too boring for retail speculation. But neglect in markets creates opportunity. The question isn't whether these assets will reprice. The question is, when does the market recognize what's already happening beneath the surface? The commodity analyst reviews central bank behavior, another critical signal. Central banks globally have been accumulating gold at the fastest pace in decades. China, Russia, India, Turkey, Poland, all building reserves. This isn't random. It's strategic diversification away from dollar-denominated assets. And when central banks buy gold aggressively, private investors eventually follow. Silver, as gold's smaller, more volatile cousin, tends to amplify that move. The pattern is historical, the setup is current, the catalyst is forming. Now, back to energy equities. The sector analyst identifies specific opportunities within the broader theme. Upstream producers with low-cost production and strong balance sheets. Midstream infrastructure companies collecting toll-like fees on energy transportation. Integrated majors with refining and chemical operations that benefit from margin expansion. Each offers different risk-reward profiles, but all share the same macro tailwind: undervaluation, cash generation, shareholder returns, and a market that isn't paying attention. The institutional allocator begins building positions, carefully, methodically. Not with the bulk of the portfolio, but with enough to matter if the thesis plays out. 5% in energy equities, 3% in silver and silver miners, enough to capture the upside, small enough to survive if the timing is early. Because timing, in commodity cycles, is never perfect, but direction is often obvious in hindsight, and right now, the direction is becoming clear. Energy and silver are setting up for moves that will seem obvious once they've already happened. The only question remaining: will you be positioned before the market realizes what's coming, or will you wait until consensus catches up and the easy money has already been made? History suggests those who wait pay a premium. Those who act early capture the opportunity. The setup is complete. The pieces are in place. What happens next depends on execution. The portfolio manager sits in silence. Before him, 2 screens display everything he's analyzed over the past 6 weeks. Energy fundamentals on the left, silver dynamics on the right. The thesis is clear. The opportunity is evident. The timing feels right. But between understanding an opportunity and executing on it lies a gap that separates successful investors from everyone else. That gap is discipline. He opens a blank document and begins writing his execution framework, not because he needs permission, but because every significant position requires a plan. A plan for entry, a plan for management, a plan for exit. Without it, conviction becomes recklessness. First, position sizing. This is where most investors fail, not in their analysis, but in their allocation. They either bet too small, and the opportunity passes without meaningful impact, or they bet too large, and normal volatility shakes them out before the thesis plays out. The institutional standard is clear: allocate based on conviction and risk tolerance. For energy, he decides on a 7% portfolio allocation, enough to matter if the sector reprices, small enough to withstand a drawdown if timing proves early. For silver and silver mining equities, 4%. The volatility in metals is higher. The position must be proportionally smaller. Together, 11% of the portfolio positioned for a commodity reflation scenario that almost nobody is pricing in. It feels uncomfortable, and that's exactly right. Comfort in positioning usually means consensus. Consensus usually means the opportunity has already been priced. Next, the entry strategy. He knows better than to deploy all capital in a single trade. Markets don't move in straight lines, even when the thesis is correct. Volatility creates opportunity if you have capital to deploy into weakness. His approach is methodical. 1/3 of the allocation goes in immediately, establishing the position. 1/3 waits for a 10% pullback, if it comes. The final third remains in reserve, for either a deeper correction or to add on confirmed momentum. This structure ensures he's never fully committed too early, and never entirely out if the move accelerates. Now, security selection. In energy, not all companies are equal. Some are levered to price, others are protected by integration. Some generate free cash flow at $50 oil, others require $70 to break even. He builds a diversified basket, carefully weighted, 40% in large cap integrated majors: ExxonMobil, Chevron, Shell. These companies have fortress balance sheets, dominant market positions, and dividend yields that provide downside protection. 30% in high-quality upstream independents: ConocoPhillips, EOG Resources, Canadian Natural Resources. These are pure plays on commodity prices, with operational excellence in low-cost structures. 20% in midstream infrastructure, enterprise products, energy transfer, Kinder Morgan. These companies collect fees on energy transportation, insulated from price volatility, generating stable cash flow regardless of where oil trades. 10% in energy services and equipment: Schlumberger, Halliburton, Baker Hughes. These are recovery plays, companies that benefit when drilling activity eventually accelerates. The basket is constructed to capture the thesis from multiple angles, reducing single company risk while maintaining thematic exposure. For silver, the approach differs. Physical silver provides pure metal exposure, but lacks leverage. Silver mining equities provide leverage, but carry operational and geological risk. He splits the allocation: 50% in physical silver through exchange-traded products, iShares Silver Trust, Sprott Physical Silver Trust. These products hold actual metal, providing direct exposure without company-specific risk. 30% in senior silver miners: Pan American Silver, Hecla Mining, Kerr Mining. These companies are established producers with diversified assets and operating history. 20% in silver royalty and streaming companies: Wheaton Precious Metals, Franco-Nevada. These companies provide capital to miners in exchange for future silver at fixed prices, capturing upside without operational risk. The structure balances pure exposure with operational leverage. Now comes the critical part: Risk management. Every position requires predetermined exit criteria, both for loss and for profit. For energy equities, he establishes clear thresholds. If the sector falls 15% from entry without fundamental deterioration, add to positions. If it falls 25%, reassess the thesis entirely. Something fundamental may have changed. On the upside, he won't sell based on percentage gains. Instead, he'll monitor valuation multiples and free cash flow yields. When energy stocks reach average market valuations, when their earnings multiples match the broader index, that's the signal to begin reducing. Not because the rally is over, but because the easy money has been made. For silver, the approach is more technical. A break below $28 per ounce would violate key support, triggering a 50% position reduction. A break above $35 would confirm the bull trend, justifying full allocation. Above $40, he'll begin taking partial profits, not because the move is finished, but because prudence requires harvesting gains. The risk analyst in him asks the uncomfortable questions. What if demand destruction happens faster than supply constraints? What if a global recession crushes commodity prices regardless of fundamentals? What if alternative energy adoption accelerates beyond projections? These are legitimate risks, and they can't be ignored. His answer: diversification and humility. The 11% allocation is significant, but not catastrophic if wrong. The remaining 89% of the portfolio remains in other assets: technology, healthcare, fixed income, real estate. If the commodity thesis fails, the portfolio survives. If it succeeds, the portfolio outperforms meaningfully. That's the essence of asymmetric risk-reward. Limited downside, substantial upside. He also considers timing risk. What if the thesis is correct, but the catalyst takes 3 years instead of 18 months? Opportunity cost becomes real in that scenario. His solution: periodic review. Every quarter, reassess the fundamentals. Is underinvestment still constraining supply? Is demand remaining resilient? Are valuations still compelling? If yes, maintain positions regardless of price action. If no, exit regardless of gains or losses. Discipline over ego, process over outcome. The veteran investor reviewing the final framework recognizes something important. This isn't speculation, it's strategic positioning. Speculation chases momentum without regard for fundamentals. Strategic positioning identifies mispricings, constructs thoughtful exposure, and waits patiently for market recognition. The difference is everything. As he finalizes the plan, one thought dominates. The hardest part of commodity investing isn't finding the opportunity. It's having the conviction to act when the opportunity looks obvious, but nobody else agrees. In 1999, buying energy stocks seemed foolish. In 2020, buying commodities after a price collapse seemed reckless. Today, allocating to energy and silver while the market chases artificial intelligence and technology feels contrarian, but contrarian, when supported by fundamentals, is often correct. The crowd isn't wrong because they're stupid. They're wrong because they're looking at different timeframes and different incentives. Institutional mandates force ESG compliance. Index funds mechanically underweight unloved sectors. Retail investors chase momentum and narratives. None of them are positioned for a commodity reflation that doesn't fit the prevailing narrative. And that is the opportunity. The strategist closes his laptop. The analysis is complete. The framework is established. The positions will be entered tomorrow. Now, the only thing left is patience. Because markets don't reward those who are early with immediate gratification. They reward them with asymmetric outcomes when the market finally catches up to reality. Energy and silver are setting up for moves that will define the next market cycle. Not because of hope or speculation, but because of mathematics, supply constraints, demand resilience, and valuation dislocations that can't persist indefinitely. The question was never whether these assets would reprice. The question was always who would be positioned when it happened. And now, the answer is clear. Those who understood the setup, those who built disciplined positions, those who managed risk intelligently. They won't be lucky, they'll be prepared. And in markets, preparation masquerading as luck is the only edge that matters. The opportunity exists, the framework is built, the execution begins. What comes next is already in motion.